So looking at Tuesday's earnings batch, we've hit this fascinating pivot point. Mid-sized tech firms are suffering sudden component price hikes strictly because their vendors also supply Nvidia. Meanwhile, Wall Street's biggest banks, we're tracking JPMorgan, Goldman Sachs, and Aehr Test Systems today, well, they're pointing out that their hottest commercial loans right now are actually for the local plumbers wiring the AI boom.
Right. The multi-billion-dollar tech build-out has officially trickled down into the physical supply chain. For a long time, the AI story was mostly silicon and data center design, but listening to JPM today, they noted that these exact data centers are generating a wave of standard commercial loans specifically for plumbers, electricians, and HVAC technicians just to physically cool the servers.
Which is such a wild shift. I mean, we focus so much on the elite tech layer, but the real growth bottleneck is suddenly the HVAC guy in Ohio. And you see that same physical supply chain strain absolutely crushing the smaller tech players. Look at what happened with Aehr.
It's essentially, it's a literal AI inflation tax. Aehr got hit with sudden 40% price hikes on standard power supply components, not because their own tech changed, but entirely because their vendors realized they can command massive premiums selling those exact same parts to Nvidia. If you're a mid-tier hardware firm right now, you are paying the hyperscaler premium just to secure basic parts.
Exactly. Though I should say, the financials underneath both of these headline stories were pretty messy. Aehr printed a positive non-GAAP profit on a massive strategic pivot, but they actually funded it behind the scenes with highly dilutive stock sales. And over at JPM, they reported a huge headline beat, but the bulk of that was just a one-off paper swap for Visa shares.
Stripped of that paper swap, JPM's core operating income barely moved, which brings us to the biggest philosophical split of the day, this battle over the myth of infinite operating leverage.
Oh, right. Goldman and JPM effectively telling completely opposite stories about how far you can push your employees without breaking the system.
Exactly. Goldman was boasting about generating 40% higher revenues while physically shrinking their headcount. They are leaning heavily into the idea of tech efficiency, but Jamie Dimon explicitly called endless operating leverage a crazy notion. He pointed out that real physical banking growth eventually requires cash overhead.
So he hiked JPM's expense limits by $2.5 billion simply to support their trading boom. I kind of love that. At a certain point, you cannot optimize your way out of needing more humans to handle the volume.
Physical limits always win. And looking at next quarter, those constraints are moving from labor to pure regulation. Goldman is pushing right against the floor of its regulatory leverage ratio. They might actually have to start turning away high-quality prime financing deals strictly to repair their balance sheet.
And for Aehr, their entire growth narrative now hinges on forcing a single, highly concentrated AI hardware order specifically in Q2. If that slips, the surrounding quarters are going to look incredibly lumpy.
So whether you're a global bank or a niche tech vendor, the central takeaway today is that the bill for physical reality is finally coming due.
The physical economy always gets the final word. The individual company episodes in the feed pack exactly how these banks are modeling out those traditional infrastructure loans and how smaller companies are navigating this pricing tax. We will catch you tomorrow.